Welcome to another episode of Straight Talk on Stocks with Kevin Hurley, managing partner of Hurley Investments LLC, and Jeffrey Dunyan, CEO and owner of Safe Option Strategies. Good morning, Kevin. Welcome back.
Good morning from out here in Henderson, Nevada.
How was the travel yesterday?
Pretty good. Pretty easy. I actually made it into town at rush hour, and because I came in from the Utah side, shot up left towards Henderson, I had no traffic. It was pretty good. Missed rush hour traffic in Las Vegas.
Which is definitely a good thing. No one likes rush hour traffic in Las Vegas.
It's amazing. It's gotten like California. I've come in here sometimes. It's taken me 25 minutes to get through Vegas.
It's like California, except it's for a whole whopping 10-mile stretch versus 100 miles from the north end of LA County to the south end of Orange County. That's the difference.
Very true.
All right. So, by the way, skiing yesterday sucked. I think I told you that.
Well, they're dumping many feet of snow out there for next week for you.
I should have gone today instead of yesterday. The mountains got 2 feet of snow. Yesterday, the problem was the snow was falling heavy. Visibility was almost nothing on the slopes. Even with good goggles, there was little visibility. And the snow that was falling until it got late in the evening and overnight, it was so heavy and so wet and so sticky. I've got good wax on my skis, and it still felt like I had brakes on my skis that were grabbing. I mean, I'd be flying down the mountain for a little stretch, almost come to a stop and go right out of the front of the ski boots. So it just wasn't, it'll be fantastic this weekend. The new snow, 2 feet of snow overnight. That's, I know a lot of our listeners don't ski and don't care about the snow, but I'm going to talk about it as long as I keep skiing. As long as my age allows me to keep skiing, I'll keep mentioning it.
Well, let's do this. Let's get out of here and go visit Houston next week.
Yeah, Houston and Dallas next week. That's going to be fun.
Check out my parents. Maybe do a little fishing.
Good luck with that. All right, let's talk some stocks. That's what we're here for. Dow Jones up 217. You can see I've started out the presentation. I've still got a chart. Let's switch to the Dow real quick, and then we'll come back to Netflix, because we got to talk about Netflix and what they did yesterday. But let's talk for a minute about the Dow Jones Industrial Average. Right now, what are we? An hour and 20 minutes into today's trading session. Another strong start. Up 210, NASDAQ up 65, S&P up 25. All three indexes sitting at close to 1% to the upside. And the only headline I saw that seemed, for lack of a better word, meaningful, was that there's just more optimism in the market overall and more optimism in what's going on with China. There's your big headline. Dow jumps 200 points after China offers a way to eliminate U.S. trade imbalance.
Well, I mean, that is only what? An extra $360 billion to the GDP numbers if they'd match us at the 550 we buy from them.
Hey, if we could get another big country to fix their trade regulations every time we have a government shutdown, I say let's keep the government shut down permanently. Because the money we'll make from China becoming a fair situation is going to be 100 times better than what we're losing on. Let me ask you something.
Well,
I'm going to get political for a second.
Like that, Jeff, you're exactly right. But a long term, for all intents and purposes, I look at some of my kids and they're such a me, now kind of generation. I don't think there's enough of us that are willing to look long term to see the benefits. I think it's just, hey, give it to me now. I want it now. I want my cake, want to eat it. It's shocking.
Yeah, but let me give a thought on this, and then we'll talk about stocks since that's what we're here to talk about. I thought about the numbers that I've been hearing on the government shutdown, and I this is an honest question. This is not a loaded question and not a rhetorical question. I don't know the answer to this. When they say we're losing money, a certain amount of money each week on the government shutdown. Because what I've heard people talking about is we're losing money, and it'll have this like 1/4 of 1% effect to the GDP, or 0.1% or whatever it is, effect to the GDP each week that it's closed. Where are they coming up with that other than we're going to keep paying these people who aren't working, and that's what's costing us money? Because here's ultimately the question. With the exception of the IRS, and maybe the numbers come directly from the IRS and the lack of taxes collected, because if that's not it, government agencies do not produce anything. Is the only loss the money that we're going to pay them anyway while they're not working?
No, again, in all reality, you're looking at shutdowns in Zion's and Bryce's National Forest. Some of the tourists, ski resorts that are on BML land and National Forest land are not having those tourists be able to enter some of those parks. I think it's a trickle down. It really is a trickle down economics factor that I believe, where if you shut down certain things, you're going to lose money in other things, which lose money for small businesses in those areas. Blah, 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 blah. It's just a trickle down economic.
Okay. All right. I get that. I understand the premise there, but that leads, I keep questioning this. There is not a government agency in existence that pays for itself. Every government agency we have drains tax dollars. None of it. The post office for a lot of years, this changed, I think 15 or 20 years ago or more. The post office used to pay for itself. The days are long gone that the U.S. Post Office has paid for itself. So there is no government agency that I'm aware of that even covers its cost of existence. So how are we losing money when we're shutting them down, except for the fact? Now, I get what you're saying about trickle down, because some of these government agencies, there's other economic factors at play. When a certain government agency is shut down, then it can't use private vendors that it pays and so forth. And so there's where the actual hurt of the economy. But other than the paychecks that we're going to give these people anyways for the time off, look, I know right now today they need to buy groceries, they need to make mortgage payments, they need to make car payments, they need to make insurance payments, and they're not getting a check. But they're going to get back paid for this time they're not working. I'm not saying it's not a hardship, but where are we losing money other than the fact that every one of these non-essential government employees is on paid vacation? They're on 100% full paid vacation right now.
Well, remember,
they have to wait for their paycheck.
The government payments count for some of the GDP. So 800,000 people that are in the consumer, how to say it? I don't say it's consumer credit, but 7% of our GDP is made out of the consumer buying. That's a chunk of people not buying because they don't have the money. It will be made up. But again, I'm thinking of the Burbot Bash out in Manila, Utah. Without having the Department of Wildlife and services there and running it and so forth, it shut down. It brings in 2,000 people. So that's 2,000 people that could be looking for food, buying bait, hotels. All that's going to be shut down this year.
It brings in 2,000 people over a decade. I mean, there's 3 people there on any given day. Nobody knows about it.
It all comes for the Burbot Bash weekend. So, and I know 2,000 people is not a huge amount, but that's 2,000 people.
I get what you're saying, though. It has more to. So it has to do with 2 things beyond the fact that these people are getting paid time off. It has to do with the fact that all of those dollars that they would be getting in their paycheck are then spent into the economy, their groceries, their gas, their entertainment, their restaurants, etc. And then the I get it, but that also tells me that it's straight up speculation, and I don't 100%. think I'm not certain that they're factoring in how much we would be saving if we just didn't pay these people and said, hey, go get a job in the private sector. Do like everybody else does when they get laid off. Do like every other human being on planet Earth does when they get laid off. They go look for another job. Let the private sector fill this stuff. Okay, enough of that. We got to talk some stocks. Sorry.
Let's talk stocks.
All right.
Netflix.
market Dow up over 200. Let's go to Netflix, because Netflix, this will never stop fascinating me, how the markets react to companies' earnings reports, to the numbers that come out in companies' earnings reports. Because here's what happened with Netflix. Let's recap the numbers. 8.8 million new subscribers. That number blew out analyst expectations. That was a home run. Maybe it just got over the fence, but it was still a home run. It wasn't out of the park, but it was still a home run. But Netflix came in on a slight miss on revenue. Do you, off the top of your head, I don't have it on a screen in front of me, do you know what the revenue numbers were supposed to be and what they ended up?
I thought it was more than a slight miss, but I'm not active in Netflix right now, so I don't know.
Okay, let's see if we can find out really quickly. But here's the thing: Netflix is down a little over $12 a share right now, down about 3.25%. I'm going to go back to the chart in a minute. I want to see if I could find really quickly. Netflix analysts go gaga and raise price targets even as stock stumbles. Market reaction to Netflix will tell us a lot. Where's the numbers?
Those are analysts, though.
I know, but I want to see what I just don't remember what their expected revenue was and what their actual there it is. Sorry, earnings. This will tell us. This should tell us. Okay, so but here's the bottom. As I'm trying to get these actual numbers, not that it's real super important, but as I'm trying to get these actual numbers, the bottom line with Netflix is that for the last 5 or 6 years, investors care way more about new subscriber growth than they do about revenue and profits at Netflix. Now that may at some point in time catch up with them. The day may come where Netflix has to have a beat on revenue and has to have a beat on profit, or people are going to lose a little bit of faith in them. But I don't think that day is here yet. This sell-off that's going on right now on Netflix, and when you're talking about a 3.3, a 3.4% sell-off, that's nothing like what some stocks have been punished for an earnings miss. It's not even close. 3.45% as we're speaking. Okay, that's a sell-off, obviously, but I did something different with our chart here today. There's your 200-day moving average, the pink line, and no wonder it got a bounce off of there. For our listeners, for the people that are listeners only, the 200-day moving average is setting at approximately, well, let's not give you an approximate. Let's tell you where the 200-day moving average is.
314
moving average is at 334 and some change. Let's call it 334.75. The lowest Netflix has been today, 336.73. So it bounced about $2 higher than the 200-day moving average is where it bounced from its session low so far. A lot of time that it can still trade. And who's to say there won't be a bigger sell-off later in the day? We don't know right now. You've got the 20-day moving average is down around 313. The 50-day moving average is clear down at 288. I'm going to make a prediction for you on Netflix, Kevin.
Fire away.
I think the 200-day moving average holds because it coincides with the most recent strong level of technical support. You had a support level at around 330 and some change back in August. It tested briefly as support in October, and then after it fell through it in October, it tested one time in November as resistance. It tested again ever so slightly a week ago as some resistance before it broke through. I think that 330 to 335 range holds up as a support level right now. And because of the subscriber numbers, I think within a month and a half to 2 months, Netflix is going to be testing all-time highs again above $420 a share. That's my prediction.
I'll go the other direction. I'm going to tell you it has priced for perfection. It just had a $100 plus run up. I'm going to tell you that sucker is going to go back down and test 280. It's going to test the lows, and it's going to do it on the uncertainty of not how well it's doing, but it'll be a Reed Hastings uncertainty that people just don't trust. And you'll find some analysts that'll come out and say, well, he's got to raise prices again because they're failing because they're so in debt for their new content. It'll be something that's not completely accurate, but
Okay.
I don't know. I haven't seen technology rewarded in the last 4 months. I don't think it's going to start being rewarded with Netflix.
I do. I'll tell you why you're wrong on that. 8.8 million new subscribers adding on to their already amazingly high subscriber base, and they already announced a $2 per subscriber increase. That fixes the revenue problem over the next quarter, and that's what investors are going to be focused on. They're going to forget about the slight miss on revenue this last quarter. Investors have short memories, Kevin. They're going to forget about the revenue miss on this last quarter. They're going to stay focused on how amazing Netflix's original content is. They're going to stay focused on the new subscriber numbers, and they're going to stay focused on the most recent price increase. And I will agree with you on one thing. Reed Hastings has to stay out of his own way. He could screw it all up, and I'm not saying that there's no possibility that he'll screw it up, but hopefully right now today, the board of directors is sitting down with Reed Hastings and saying, all right, we're down 3-4%. That's not a big deal. We missed on revenue. We knew that was coming. We can survive 3-4-5% down. Keep your mouth shut. Don't say a word for the next quarter, and all of this gets taken care of. And none of it is an issue.
Maybe. I just don't see it.
Well,
hey, I'm going to mute myself here for a quick second.
Okay. Then I can talk. That means I can talk about what I want to talk about. So I'm going to, while you're off air for just a minute, Kevin, I'm going to talk about the trade, a trade that I like right now. It has nothing to do with Netflix, because I'm going to wait and see where Netflix puts in that bottom, and then I'm going to be prepared. I'm telling you right now, people, I'm going to be prepared to go long on Netflix in a big way as soon as I have some confidence that level of support is holding. And I really do, my opinion is that level of support is going to hold somewhere in that 330 or above range and then go up. So here's what I'm looking at trading in the very near future. Nike is on this fantastic run, and more important than the run they're on is the fact that they're just now breaking through this level of support, this level of resistance. There we go. Okay. For the video viewers, they can see the line that I've got on the screen right there in the 78, 79 range. Nike had a nice breakthrough that today. They've been on a steady bullish run since Christmas Eve, since every company that we look at tested the bottom on Christmas Eve. Nike has had as strong a run as anybody, moving up from 67, now above $80 a share. So you're talking a $13 run divided by that 67 price. Nike's up nearly 20%. They've broken a key level of resistance at somewhere in the 78 to 79 range. You've got a nice level of resistance that they broke through. They're going back to $85 a share, and Nike doesn't have an earnings report coming up that could change people's mind about being bullish on this stock right now. If you want a really attractive short-term trade, and that's the key to this one, is it's a very short-term trade. If you were right now today to buy the Nike in the money 77.50 long calls that expire next week on the 25th. If you were to buy those for $3.15, at the same time, you could sell the 80 strike short calls for about $1.20. So 313 minus $1.20, you're somewhere, you're going to end up somewhere in the 190 to 195 per share range. And here's what that means. If you get called out between now and next week at 77.50 and you have the right to sell at 80, you're going to make that $2.50 per share profit in between, and you will have spent a maximum of 195 to get into it. That means that the minimum, you're going to make a 55 cent per share return on a 195 maximum risk, 55 divided by 195, you're going to make a 28% return on this investment in just barely a week. These options will expire next week. All Nike has to do is stay at or above $80 a share between, and you don't have to stay in the trade that long. I would get into this trade, and as soon as I could get out with 15%, I would take it. And any week that I could make 15% on a trade is a good week, and I'll take it and I'll do it. And that is my new trade for the week.
Where did you go?
Yeah, you took off on me. What I did was I explained to people a brilliant short-term Nike trade that can net close to 30%, but that will jump out as soon as we hit about a 15% mark.
I'm looking more at FCX, Freeport-McMoRan, with gold trading up towards 1,300. Silver's made a good run from 14 up to 15.5, 1585. I think that precious metals mining company could do really good this quarter. It's ridiculously cheap right now. It's in that $11.88 range. Buy it for $11.88 for 30 cents. You can get a $12 long put for a month. It reports next Thursday.
Okay, so it's actually they're actually trading over 1250 on today's move up. Would you want a long put that's a little closer to the money?
Yes. In fact, if they're up to 1250 right now, actually, I think it says, where is it trading at exactly?
1254 right now.
1254. So yeah, get it at probably 1254. Buy a 1250 long put out to February 22nd. Probably cost you 40 cents. You're going to have 45 cents of risk for me on $12,000. So you're looking at $45 of risk.
When do they report?
They report on Thursday after the market close.
So right now that 1250 long put is about 67 cents a share. That's on the mid price.
Wow, lots changed in 24 hours, hasn't it?
Well, because you're less than a week away from earnings now, so you have some implied volatility pumping into the option prices just based on that alone. And then the fact that they've had since the first trading day of this year, they've gone from $10 to $12.50. That's a 25% move up. A combination of that fast to move up and as close as they are to earnings, you've had a lot of implied volatility pump into those option prices just in the last 48 hours. So does that change? Let me put these numbers.
It doesn't. It doesn't change it for me because I've already got 1,000 shares. It's a $12,500 investment that I can protect and only have $670 at risk with your numbers. And I'm looking at $14. I'm looking at that $14 range where they'll be stopped at the 200-day or looks like that's the 5-day. It was up around 14 is where I saw the resistance at. So
with the stock and with the February 22nd long put, you're in the neighborhood of $13.20 to $13.20 to $13.25. That means you've got somewhere in the neighborhood of 70 to 75 cents per share risk. Do you worry that that's a little bit, just a little bit high from a percentage standpoint on that size investment?
When I look at $700 versus $12,500, I'd rather take $700 of risk than just let it float by itself.
I disagree. Excuse me. Sorry, I not disagree. I agree with you wholeheartedly on that. I absolutely wholeheartedly agree with you on that. But would you not want to maybe go out? I don't know, maybe March by the time you even get to you could pick up 30 cents a share on a March 14 strike short call. That's not terribly far out in time. If you were willing to go clear out to May, you could jump up to a 15.
Chart really quick. If you erase all that, their last earnings was there in September. And normally they'll make about a 4-week move after their earnings and then run sideways or flat. You'll see a perfect example on that chart. So could I go out farther? I could, but historically, that's their earnings, and then they run sideways flat.
I'm not talking farther out
in a row.
I'm not talking farther out on the long put. I'm saying, would you consider putting a 15 strike? Right? See, here's the thing. For the type of trade you're doing, let's say 75 cent per share risk. But your 75 cents divided by a $13.20 investment, you're about a 5 to 6% risk on what normally you desire to set up as a super, that
True.
I agree that that's a lot better than the risk you have if you're just buying stock and trying to ride it through earnings. But my question is, you could take that risk from 5 to 6% down to a couple of percent if you went out to May and threw a 15 strike short call on that for almost 40 cents a share.
If I capped it. So there's a reason why I'm not capping it. There's a reason why I'm not going to cap a lot of my positions, particularly because the high for the year is up at 2025 and a multi-year high is up at 42.
Okay. So you think it can go back to that?
I could always roll it farther out, but I think there's a lot of balance in a lot of the names that I'm trading. Freeport-McMoRan being one of them. Bank of America, which was down 40%, Apple down 40%, Baidu down 40%, Ford down 40%. A lot of what I trade has a lot of bounce back in it, I believe. Okay. So I'm not looking to cap anything at this time.
To get profitable, if you look at where that 50-day, I still have that 200-day moving average on there after the cost of those long puts, and most of that disappears the day after the earnings report. The implied volatility crush takes place the day after earnings, so a lot of that disappears. So maybe you get back 10 cents, maybe you get back 5 cents on that long put. That means you've got to break above that 200-day moving average to see that trade get profitable.
What I may do, and my plan was to be aggressive on a short put, even maybe going in the money on a short put against my long put, because I have quite a bit of margin sitting around in my personal accounts for these.
Okay, and then just the risk of adding some more shares to that if you do something like that. I got the biggest grin on my face when the military plane is sitting on the tarmac, engines warming up, and Trump says, "Hey, Pelosi, I don't think you should make this overseas trip on the government dime right now with 800,000 government employees not working. Feel free to fly commercial if you want." It's a tit for tat, which is kind of pathetic. This is like a junior high spat between a couple little girls, but I got the biggest grin on my face when he did that. I thought that, to me, is hilarious. And the Trump and the Republicans are still getting blamed in the polls at a greater percentage than the Democrats are. But I got to tell you, the longer Nancy Pelosi says she's unwilling to negotiate and Trump says he is willing to negotiate, that margin is going to disappear and the Dems are going to feel some pressure. So I say let the shutdown continue.
Well, the problem is, Jeff, is they have Schumer and Pelosi on record talking about how horrible the immigration problem is and how all these people are coming to our country and we need border security. And unfortunately, they just don't like Trump. They don't like Trump.
Well, and over time,
so they're backing off on a decade of, hey, we got to secure our border, but not if it comes from Trump's mouth.
It's going to get harder and harder for the media that hates Trump and loves the Democrats. It's going to get more and more difficult for them to hide the fact that you've got one party willing to negotiate and the other party not willing to negotiate. And eventually the tide is going to turn. It's never going to get worse for Trump in this polling because his base is behind him 100%. It will get worse for Democrats the longer they choose to not even negotiate. And it'll wear. And the reason I bring this up, this is more of a stock trading show than a political show, but I say let it go on because so far this government shutdown is not hurting the markets. So let it ride. I still feel bad for the people who are without their paychecks and they've got bills they've got to pay right now today. I'm not completely unsympathetic to those individuals. However, from an economic standpoint for the country as a whole, they're going to have to take it on the chin just a little bit longer. And they're the ones more than anyone who should be putting the pressure on the Dems. It's those 800,000 government workers who should be putting major pressure on the Dems and saying, get to the freaking negotiating table and give him something so that we can get back to work. because he says he's willing to negotiate and you say you're not. And if those government employees, I don't care where their personal politics are. I don't care if their personal politics are hardcore liberal, we hate Donald Trump, or if they're hardcore conservative, we stand behind him. They better start putting pressure on the Dems to come to the negotiating table, because it's the Democrats who are showing a complete unwillingness to negotiate.
Can I make a comment? I do think that the whole idea for this tit for tat, and I'm going to say started by Pelosi, saying, President, we don't want you in the House to do your State of the Union address this year. I believe she said that so that he can't get out some true facts. So he can't have an unbiased media outlet where he can say, hey, I've done this, I've done that, I've done this. His little tarmac thing was hilarious. Don't you think you should be here negotiating? Don't you think you should have been here for Christmas?
You really
could go to the Bahamas instead of work. What are you doing, lady?
Yeah. So one final thought on that, because I agree with it. She pointed out, Pelosi pointed out, the State of the Union is not written in the Constitution. There's not a set date. It doesn't correspond with a president's birth date or anything like that. So Trump should say, you know what, Nancy, you're exactly right. There is nothing constitutional about doing the State of the Union. So I don't care if you invite me to the floor of the House or not. I am going down to the southern border. I'm going to have 10 times the number of people at the southern border that we normally have in the chamber. It's going to be silly for any of the major news networks to not carry it, because I'm going to call it the State of the Union address, whether you want to call it that or not. So if CNN wants to throw a fit and say we're not going to carry coverage of it, great. Let Fox's ratings go up tenfold that one night. They already crush every other network out there. And let him give that speech at the border with a split camera on him giving the speech and the caravan moving through Central America and Mexico right now, and see if they can still argue in their little rebuttal comments afterwards that there's not a border and humanitarian crisis at the border. And since it's not affecting the markets negatively, I say let the shutdown ride. Okay, we got to wrap up. That's where we got to probably end things. For you and for our listeners, the markets are closed on Monday. No podcast on Monday. Day off. Take a day off, at least from the markets. I know a lot of people still have to work, but pretend you're a government employee and you can't work on Monday. Oh, that was mean. I'm going to edit that out before that goes to air. All right. Have a good day, Kevin. Good luck to your son in his tournament.
Thank you. Take it easy. Appreciate being with you and look forward to seeing you next week.
Tuesday. We'll be back.
Tuesday.
Bye-bye.